As interest rates rise and house prices fall, first-home buyers are dropping out of the market.
Yeah.
But not this couple. They're moving into their new property this week.
It's been a bit volatile through this process. I mean, I think when we first started looking, we were potentially looking at a 2% interest rate, and now we've ended up at a 5.2.
They purchased this three-bedroom house for $680,000 after higher rates reduced their borrowing power.
We're comfortable at the interest rate currently, so if it can settle at that rate, at least give us 12 months to settle in and find our feet, that would be great.
Unfortunately for borrowers, the central bank has delivered another 0.25 percentage point increase to take the cash rate to 3.1%. That's the highest since November 2012. If lenders pass on the rate hike in full, homeowners with a $750,000 mortgage and 25 years left on the loan will see their repayments rise by $113 a month, which means they're now paying $1,251 more than they were before the RBA started increasing rates in May.
So already having a harsh and heavy impact on repayments, but as the RBA has made clear today, we expect that the full impact of these rate rises will be felt down the track.
Reserve Bank Governor Philip Lowe says the board expects to increase interest rates further, but it is not on a preset course. It is closely monitoring the global economy, household spending and wage and price-setting behaviour. After 8 months of rising interest rates, there is a slight reprieve in sight. The Reserve Bank's next cash rate decision won't be until February. Economists are split on how aggressive further hikes will be, with the RBA having to tread carefully to curb inflation without causing a recession.
We're expecting 2 more 25 basis point increases in the cash rate next year in February and March, and then for the RBA to hold rates steady from there for a time. That really reflects, as I said, that inflation is still too high.
Finance experts say banks have been slow to pass on rate rises to all savers.
The banks are looking at this as quite an opportunity at this stage in the interest rate cycle to maintain and actually improve their margins.
Steve Mickenbecker says those with basic savings accounts are worst off.
The best base rate in the market at the moment is 3.5%. The average is only 1.73%. That's half of the best rate. There is a great opportunity right now to shop around.
As consumer prices surge, retirees at this bowls club would appreciate earning more interest on their savings.
They're very good at putting up the mortgage rate, so they probably should do the savings rates at the same time.
Well, I don't think it's right. I think that we're the ones that helping the banks make their big profits.
You know, it seems a little bit unfair, doesn't it?
A sentiment borrowers and those putting away cash for a new house would agree with.